Hey everyone, welcome back to Wealthy Business, your go-to channel for finance, economic news, and personal growth. Today we're talking about a major shift that's reshaping how capital is being deployed in one of the world's fastest-growing regions, Southeast Asia. Venture capital, long known for chasing risky, high-growth startups, is pulling back, and fast. As Aaron Tan, CEO and co-founder of Caro, a used car marketplace, told CNBC, there's a huge flight to safety. He's not alone in saying this. More and more VC investors in Southeast Asia are now choosing safe bets over moonshots. Instead of funding the next potential unicorn, they're putting money into profitable, traditional businesses. And that's a big deal.
Check one.
Let's break this down.
Check.
Historically, venture capitalists aim for massive returns, 100 times or more, by investing early in high-risk tech startups. These were moonshots, sure, but the winners made up for the losers. But according to Aaron Tan once said, a lot of investments these days are going into companies that aren't even venture backable, because they're mostly offline businesses. Think about that. Offline, we're talking logistics companies, restaurant chains, convenience stores, even farms. That's not typical VC territory, and yet that's where the money's going. According to TrackSen, venture capital funding in tech startups in Southeast Asia dropped by 79% between 2022 and 2024, from around $10.1 billion to just $2.2 billion. Funding for offline, non-tech businesses also dropped, but only by 61%, from $1.3 billion to $527 million. Jeremy Tan from Tin Men Capital put it bluntly, right now venture funds are becoming PE funds. Let that sink in. Traditional venture capitalists are no longer chasing 100 times returns. They're now happy with 3 times or 4 times returns, more in line with private equity expectations. What we're seeing is a shift in mindset, less about disruption, more about margins. And here's the twist, many of these companies getting funding are only tech-enabled, not tech-driven. In other words, they might have an app or a loyalty platform, but at the end of the day, they're brick-and-mortar businesses. So why is this happening? Too much money, not enough returns. Many VCs in Southeast Asia raised huge funds, more than they can profitably deploy. But with few successful exits and disappointing IPOs, limited partners are starting to lose faith. Macroeconomic weakness. Economies across Indonesia, Thailand, and even Singapore are struggling. And exits, the holy grail of venture capital, are few and far between. Overvalued startups. Many startups are still priced too high and the market correction hasn't hit yet, so investors are holding back. Fragmented markets. Southeast Asia isn't one unified market, it's a mix of languages, laws, and cultures, which makes it way harder to build scalable businesses than, say, in the United States. So where do we go from here? According to Yinglan Tan, founding partner of Insignia Ventures, the companies with real moats in Southeast Asia are atoms. That means businesses that aren't just digital, but have physical infrastructure like logistics, licenses, and local operations. Why? Because pure software companies face brutal competition from global giants like Microsoft and Meta. But companies with offline advantages are much harder to displace. And here's where it gets interesting. Start with a traditional business, then inject it with AI. Add digital tools to optimize margins, improve customer experience, and scale revenue. That's the hybrid model that could win in this new reality. The golden age of passive investing in high-growth startups may be fading, especially in Southeast Asia. Now, the name of the game is co-creation, building operationally sound, locally adapted businesses with both offline strength and digital scalability. And if you're an investor, entrepreneur, or just a curious mind watching this, here's the big question. Is this the death of innovation or just its evolution? Let us know your thoughts in the comments below. Don't forget to like, subscribe, and hit the bell icon so you never miss an update here on Wealthy Business. Until next time, keep learning, keep building, and stay wealthy.